Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about JP Morgan. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we talked about JP Morgan. And in particular, we talked about buying long in the money calls on JP Morgan. Right now, inside the options playbook, I'm highlighting a section in the rookies corner that has the fundamentals that we have behind the actual option strategy. It's actually called buying leaps calls as a stock substitute. So we're using an option contract as a surrogate for the stock. And in particular, if we're trying to accomplish that goal, it really means that we're using options more so to invest in an underlying security as opposed to speculate on a potential movement. And we focused on earnings. This week, there's been a lot of financials. 7 of the biggest financials have announced earnings this week. And I'm going to kind of highlight them right now. We had at the beginning of the week, we had Goldman Sachs and JP Morgan. We talked about both of those on the call on Tuesday or on the video on Tuesday. And then we had Bank of America, Citigroup, Wells Fargo, Morgan Stanley, and US Bank Corp. Now, they've all announced earnings this week. The banks in general have had a very good performance since the beginning of the year. They've been down a little bit. And here's part of the reason why. If you look at, and I'm highlighting, here's my watch list inside the Ally Invest dashboard. And I added to my VIX watch list here the interest rate, the 10-year, the TXN, which tracks interest rates on the 10-year note. And basically the way it works is if we see the quote right here, which I'm kind of highlighting at the bottom of your screen, is 13.12. That means that that basically is the interest rate that we're looking at, 1.3% overall. They'd multiply it by a factor of 10. And then I have the chart over here, and it's kind of showing what's happened with interest rates. So now, overall, the banks would like the yield curve to be in their favor. They want longer term rates to be a little bit higher and have a decent yield curve overall. So this hurts the banks in general. And then there's been some inflation fears, but inflation fears aren't as much of a concern as interest rates are at this point in time, but they both matter as far as the financials are concerned. So we've had a fairly decent sized run up, like I said, from the beginning of the year in almost all those stocks that we have mentioned. Overall, if you look at the XLF, well, actually, I can even pull up a couple quotes here. I do have a financial list of stocks here and see what we're doing today. Goldman's down a little bit. Wells Fargo is down a little bit. Bank of America, JP Morgan, they're all giving back a little bit of gains overall. So if we're looking at the banks in general, the XLF was up about 25% from the beginning of the year. Goldman Sachs has done a little better than JP Morgan. But in general, it's just been an interesting area that's been a little bit undervalued since coming out of our situation with the COVID vaccine, and now that the economy is heating up. So there's been some focus in the financials overall. So we build this trade as a fear of missing out. And why are we using those terms? We've had a big run up. People are a little bit nervous. We have some interest rate concerns. So how can we participate in this sector and still have limited and known risk to the downside? And that's where options can help out if we're looking at the fact that, well, we were going to buy 100 shares of JP Morgan, but instead we decided to buy one call option. We're going to go out to January of next year. That was the trade. And then we're going to go deeper in the money. So we have an option that acts a lot like the stock. And to determine that, how deep in the money we went, we were looking at an 80 delta. Now, I'm going to highlight that once again. That concept and what we talked about is in this section of the options playbook. If you have the hard copy, you can look for the rookies corner, but this is where it is on the website. And let's see what happened with JP Morgan. So on Tuesday, at noon Eastern time. This is a 15-minute chart, so we're only going back a few days. This is noon on Tuesday Eastern time, and we always tape the show live, so we're always dealing with live quotes. Stock was pretty flat while we were doing the show from noon to 12:30. Then we had a fairly big run up all the way going into Wednesday. Choppy day. Now these aren't wide swings because you're looking at 154 to 157. So this was after the earnings announcement. Remember, J.P. Morgan and Goldman Sachs were the first two to announce at the beginning of the week. And so then we had a little good opening, came back down, back up. Guess what? We're right back where we started. So 154 was approximately where the stock is at. Now we've had a little bit of a down day today. And so let's go to the Ally Invest option chains and see what happened. Okay, so stock is at 153.52. So it's down about 50 cents from when we put the trade on. And if I look at my screenshot from Tuesday, we saw that the option contract was trading right around 12.50. By the end of the call, it was down to around 12.30 or 22.50. I'm sorry. By the end of the call, it was right around 22.30 or so. So the option hasn't really moved very much, but the underlying stock hasn't either. So at one point in time, we were up a little bit, but this is more of a longer term strategy. So I usually try to give you an alternative trade, and I kind of mentioned this on the show on Tuesday. The alternative trade here is to try to treat this almost like a stock position. Common thing we would do on a stock position when we are up on the position and looking to maybe get out of that trade by selling it at a higher price is a covered call. So we sell a call option with a strike price above where the stock is at. And we say, if the stock gets up to that level, you can call it away for me. And we get paid for saying that right now, that we will sell it at the later date if the stock goes higher. Well, the alternative to that, when we're looking in the options world and buying Leaps as a stock substitute. Now, I do need to mention that Leaps is just a marketing term that was determined by the Chicago Board Option Exchange. It just means longer term options, usually 9 months or more. We went out about 200 days, so it's not quite a leap option, but we did go out, over half a year in time. So with that said, the leverage covered call is going to be the alternative strategy today. No reason right now, the market's flat. I don't know if I would consider it. Maybe when the market ran up, I would have looked at it a little bit, but I want to sell this after the fact. And we talked a lot about that. Had a lot of great listener questions last week. Another name for the fig leaf is a leverage covered call. Now, I titled it the fig leaf a little bit, and we actually highlight the reason why right down here about the name inside the options playbook. I haven't really highlighted that before, but it has a little something to do with the fact that you're kind of covered. There are a lot of neat named option strategies in the option trading world, but this strategy is a very popular strategy that never received a name for it. So we asked our community, came up and picked one of the ones we like the best, and we came up with the fig leaf. Why? Because we're kind of covered. We don't own 100 shares of stock where you have a covered call position on. You own 100 shares of stock, you just put it on, and if it gets called away, oh well, sell my 100 shares at a higher price. I'm okay with it. With the fig leaf, you don't own the stock. You own something that's giving you a lot of stock representation. You are covered by selling a shorter term call against it, but really don't want to be assigned on it. And that's one of the things. So some people do covered calls and try to avoid assignment. But if we really don't own the stock and we don't want to exercise our longer term option because there's some time premium in that option contract, uh, the alternative strategy is a fig leaf. You just need to manage it and look at it a little closer. And I usually like to put the call option on, sell the call against it after I've had a decent run up in the underlying stock. Okay. So if the market goes down, I might never do it, right? Or you could do it to try to hedge yourself and bring in a little bit of time premium. So how would this look like? How would I do a fig leaf different than I would do a covered call? And that's what we're going to talk about today. So here is the trade that we looked at on Tuesday's stock play of the day. It's trading at 22.10. We're really not down that much. Like I said, if I was thinking about doing this call, I would look at about a 14-day option contract. Now, we've already avoided earnings, and that's a good thing. I don't want to be in this call during earnings, so we got another 3 months before that earnings period is going to happen again. Here's the calls on this side. Stock's at 153.46 right now. I, if I was doing a covered call, I would probably look at selling the 157.50 strike. Why? We got a little wide market, but I could probably get 75. Gosh, I think it's wider than that because this is 50 cents here. So I'd probably get 90 cents for that by selling that call option. I'd have to work it. We got a lot of volume, a lot of open interest. I'd work it a little bit in this instance here. But I could bring in more premium, and that's more significant when you're looking at this huge outlay of cash, which 100 shares of stock would be $15,368 if I do the math quickly. So as opposed to that, we only spent 2250 on this, or $2,250. So I don't mind bringing in a little less, offset a little time premium, and I really don't want to be assigned. So instead of selling this call option, I would move up and strike, and I would take a little less premium in. And so in this instance, this is a real good market on the 160. We're 52 by 54. We're only 2 cents wide overall. This would be the call option that I would want to sell and create my fig leaf position inside the account. Now, if I do that, I want to set an alert at 160. I don't want to be assigned on this, so I'm going to manage this trade. I'm either going to close out the trade if it gets to 160, or I'm going to roll the option contract. I'm going to do something to try to prevent this assignment overall. Now, if I get assigned, no big deal. I can exercise my option if I wanted to, or I could sell the option, which is usually the best thing to do, and then just go out and buy the stock for the assignment. You can do that on an option contract that you've been assigned on at any point in time. You can always go back out and actually just buy the 100 shares of stock. Okay. All right. With that said, let's go into the options playbook one last time, and I'm going to highlight one section here that's called rolling your option contract. And in particular, you want to look at rolling a covered call option. So this is required reading if you end up selling that call, because you need to know when you would want to roll and how you would pull off that trade. All right. So with that said, that's it for this edition of the Stock Play of the Day Overtime. We'll be back this Tuesday for the next Stock Play of the Day. Please click subscribe, ring the bell, and then you'll get all the alerts for all the stock plays of the day. Thanks for coming, everyone.